Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. There are still two immediate features to consider here on my daily chart. One is real and one is possible. The real is the late September to date descending wedge pattern, and that's currently 21.17 to 21.95, highlighted in dark blue on my daily chart. Late 2 weeks ago and again late last week, we had attempted breaks higher out of it, but both failed, and we are today back within the descending wedge pattern, with, in all likelihood, the damage done on the way to being repaired. There is no outcome to this pattern as yet, but please keep a close eye on this pattern as it will provide the immediate move of the market. Immediately below current levels, we have the congestion band 2140 to 2148, made up of the 50% Fibonacci line of the March 21 to October 23 move and the November 2017 high respectively. This support proved enough over October to hold up the market. On the top side, just above the upper trend line, we have the narrow congestion 2235 to 2237. It's quite narrow, it's only too wide, which mainly seems to work right now on a closing basis. Now further up there is a lesser Fibonacci line at 2299, which was enough to cap the market 2 weeks ago, and somewhat surprisingly. Whilst further down we have another congestion band 2069 to 21 even, which is good enough to cap prices in early July, but pretty awful in mid-September. Just below this congestion band is the flatlining long moving average, currently at 2055. We also have the rising green short medium moving average, currently at 2148, though I am not sure how good this is, but it will possibly directly impact the market this week, and it is an unknown factor in the market right now. There's also congestion between 2010 to 21 even, formed back between January to February 2017 to bear in mind. Now, as I've already stated, I can't give a direction yet on the descending wedge pattern, as we haven't broken one way or another, but I can give an idea of the size of the move in either direction, if it happens soon. Thus, a primary potential move higher would be in the 1.35 cents, with a secondary harder to reach potential higher would be in the 1.55 cents higher area. On the other hand, the primary potential move lower will be in the 0.65 cents, with a secondary hard to reach potential lower, that would be in the 1.55 cents lower zone. That deals with the immediate real feature. Now to the possibility, and that is to look at the whole early September to date action as either a topping action, or potential back down to the 19 cents zone, or as a potential bullish halfway hesitation, or potential up as high as possibly 26 cents. As I've already mentioned, this is all just a possibility right now and would require further study of the market actions to see if it happens. But I do wish to make sure that you are aware of this possibility, or these possibilities, rather than getting surprised at the last moment. Ice white sugar, European white sugar in London. From the lopsided island top formed over late September, this market has been gradually moving sideways to a little lower, and in the process getting itself trapped between three moving averages. On the top side is the gold long moving average, currently at 574.20, which has been assisted at a distance by the dark blue upper trend line extension and downtrend, currently at 591.80, and that's of the January to September this year descending triangle, as well as the 50% Fibonacci line of the July 21 to November 23 move at 592.80. Then below, we have seen the support of the flatlining mauve medium moving average, currently 552.10, along with the March 2017 high at 548.70 and the lesser Fibonacci line of 550.20. We're also seeing the green short medium moving average, currently at 561.10, enter the frame and create a golden cross with the mauve medium moving average 3 weeks ago. Though I suspect that this golden cross, much like the green short medium moving average, has been more of a nuisance value than anything else right now. You see, 2 weeks ago we saw a weekly key reversal down, and I think this weekly key reversal down is of more value than the golden cross, or even the green short medium moving average itself. That is why the market is now below the green short medium moving average and testing the support of the mauve medium moving average, as well as towards the March 2017 high. Now, should these give way, then we have the interesting situation of, apart from the action over late July, August and September, of nothing else substantial being there as support until the congestion band below between 517.80 to 506.40, made up of the April and October lows, 2022 lows, at 517.80 and 514.5 respectively, plus the congestion from early 2017, roughly between 509.40 to 514.5. This move lower has, of course, not happened yet, but it is worth considering. There's also the possibility that the early September to date action could also be an elongated bullish halfway hesitation, but that seems a bit remote right now. So in the meantime, until we break one way or another, the market seems capped by the gold long moving average overhead and supported by the mauve medium moving average below, though that is being tested today right now. Sugar white premium spread. 28 weeks ago, yes, 28 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London sugar month changeovers, but it nevertheless was a seminal moment and set in motion a lower market, though prices took their own sweet time in getting down there. Between mid-July to mid-September, the market had been testing the lows of early to mid-October last year, down in the 115 3/4 to 116 even zone. I also noted many times that though we had been held up in that region for a while, this support may not have been as strong at the time as seen back in October 2023, and this proved to be the case. 9 weeks ago, I highlighted how the market made a significant weekly pattern, an immediate countering key reversal down, and bearish engulfing pattern, punching down through this 115 3/4 to 116 even zone and down through the next congestion zone below, made up of the lesser Fibonacci lines of 107 3/4 and 104 3/4, to new lows not seen since February 2023. I spoke 9 weeks ago about the supports below, and I quote, "There are lesser Fibonacci lines further down at 107 3/4 and 104.5, but I am not sure how good these are. The next support of note will be the lows of the first week of February 2023 at 83 even, the mid-February low at 83 3/4, and the early February low at 81 3/4, end of quote. Now, I continued further, and it's an important piece I dealt with. And I quote, "The only other feature to consider is a new one I've drawn on my weekly chart, which is not as yet established, but which deserves consideration. It is the April to date descending wedge pattern, currently at 78.5 to 109.5. This is still a nascent pattern, but one worth watching," end of quote. 7 weeks ago, prices breached and closed below this pattern. It was no longer a nascent pattern, but the main pattern for the market's actions. I added 8 weeks ago, and I quote, "The key feature to watch for, apart from the obvious breakout of the descending wedge pattern itself, is when the lower trend line crosses the purple neckline extension to the significant February to September 2020 head and shoulders top, currently at 76 3/4. This will be approximately during the week ending the 22nd of November this year," end of quote. Well, these past 2 weeks we saw considered closes below the purple neckline. Now, the question last week and this week is whether the market will react the same way as it did back in early October and zoom back up, or will it try and sustain the move lower? Though it is early days as yet, it looked like prices were sustaining the move, but it is very, very precarious, especially today as we see the spread testing up to the purple neckline, but from underneath. So, what have we in the way of opportunities and barriers on the downside? I'm trying to keep it simple and short, as a much larger picture has even me somewhat scared. For an immediate support below, look to the November 2021 low at 68 even, and then the congestion zone between 55 even down to 45 even, dating from July to September 2021. Now, in the bigger picture, we have to look for the opportunities presented by the break below the descending wedge pattern. A primary target X for this would be in the 65 1/4 zone, just below the November 2021 low. And as I've said for many, many weeks now, it is doable. However, the secondary, harder, much harder to reach target X1, well, that will be down in the 1 zone. Yes, 1 even. And this has gotten me somewhat scared, as this is below what I know to be prior lows, notably my 2009 low at 22.25. All this is without even considering the implications that just possibly the move lower may have triggered targets finally for the huge 2022 to 2023 diamond top pattern. And on that, I shudder at the thought of it.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.